Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 122, we're going to look at estate planning for net unrealized appreciation in employer securities. It's a little known tax benefit that you get when you're a participant in a qualified retirement plan, and we're going to dig into how this really applies in the estate planning world, because a lot of focus on this planning strategy is on the benefit to the actual employee or plan participant, and I haven't seen a lot of guidance that really ties this into estate or transfer tax planning. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So to start with, typically when you're a participant in a qualified retirement plan from your employer, any distributions you receive are going to be subject to ordinary income tax. And it may be the case that your plan holds position in employer securities. Those are securities in your actual employer or maybe in the parent company of your employer. And if these securities are sold within the plan and then the proceeds are distributed or reinvested, then those cash proceeds, including basis and appreciation, would be subject to ordinary income tax. That's usually the rule for any qualified plan. However, for actual employer securities, you may be able to gain special tax benefits. You may be able to get capital gains treatment on the net unrealized appreciation, or NUA, in those employer securities. Now, the basis would still be subject to ordinary income tax, but the appreciation would not, as long as those are distributed from the plan to you in kind. Now, we're going to look at more of the nuances to this. So to start with, this isn't something you can just do at any time. There has to be a valid triggering event in order to be eligible to withdraw your employer's securities. So typically those include things like death, disability, the attainment of age 59 and a half, or separation from service from your employer. So for maximum benefit, from an estate planning perspective, what we're going to see is that this should be done during life in order to get the basis step-up potential for those shares. There should also be a complete lump sum distribution of your plan balance in a one-year period. So you can't cherry pick and just take out the employer securities. In order to get this benefit, you have to completely close out your plan balance and get it all as a lump sum distribution. Now, this can be mixed up in terms of strategy. You can either have an outright distribution or maybe even a rollover to an IRA, which would not be subject to tax, or a combination of both. But regardless of the method, in order to get the benefit here, you have to have employer securities that are distributed in kind to you and not rolled over in order to get the tax benefit for those particular distributed securities. And then finally, the employer securities have to be actual equity securities and not stock appreciation rights or phantom stock rights or anything like that. Now, assuming you meet that plan level eligibility, then what happens is that the securities distributed in kind to you, but not rolled over, only the in kind distributed securities get special tax treatment. So the basis in the securities themselves would be taxed to you as ordinary income upon distribution. However, the net unrealized appreciation would not be taxed upon distribution. So what happens is you get a carryover basis of the taxed basis in those shares, and then it's as if you just hold those employer securities as an investor from then on. So the appreciation in those securities, the net unrealized appreciation, along with any growth and value after you start holding those securities, would be taxed as a long-term capital gain when the securities are sold, regardless of your holding period. So obviously, since the basis is taxed upon distribution, this strategy would work best for lower basis employer securities. Now, if you want to avoid an ordinary income tax on the rest of the non-employer security lump sum distribution, you can make a rollover to an IRA or another qualified plan if you switch employers. But it's important to note that the employer securities that are rolled over don't get this benefit. Also, if employer securities are liquidated and then cash proceeds are distributed to you in kind, that does not avail you of this tax benefit either. Also note that this only applies to qualified retirement plans. It doesn't apply to IRAs. So if you make a rollover of employer to securities to an IRA, you lose this benefit as well. Now finally, when you hold employer securities in kind, then those are part of your general assets that benefit your beneficiaries under your estate plan in two ways. One is you get a step up in basis for those assets at death, which would eliminate the tax on the net unrealized appreciation if your beneficiaries or a trust which inherits that stock, ultimately sells the employer securities. And also, any distribution of employer securities is no longer subject to income tax, is income in respect of a decedent. Now, your overall estate tax picture should stay the same because the securities would have been taxed regardless of whether they were held in a qualified plan or in your individual name. However, because estate tax applies to the assets either way, one difference is that there is no Section 691C deduction available to your beneficiaries. But again, that's kind of a wash because they're not subject to income tax on those employer securities either. Now, another thing to note is that a beneficiary of your qualified retirement plan might be able to make the NUA election as a beneficiary of that plan, not an IRA, but of a qualified retirement plan. But there's other limitations that apply there that are beyond the scope of today's discussion. And I know I make a lot of this tax focus, but there's another important point I want to highlight here as well, is that from a creditor protection perspective, ERISA protects plan balances from claims of creditors unless and until assets in that plan are distributed. So as long as the employer securities are held in a qualified retirement plan, they're still protected from claims of your creditors. However, once you make that in-kind distribution out to yourself, then you lose some of that benefit or all of that benefit potentially. So it's important to note from a non-tax perspective that risk that's hanging out there as well. And overall, there's a lot of numbers that you have to put on the page and weigh, does this really work out as a good strategy for you or your estate ultimately? As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.